In this video today, we're going to discuss about what hedging is and why do you need to hedge and how do you hedge your portfolio or hedge a stock. A lot of them already are doing hedging without knowing that they're hedging it. Hedging, it sounds a little complicated, but trust me, it's super simple. You might have even done this before without knowing that it's called hedging. So we'll quickly show you what hedging is. Welcome to AntShade. So here today we're going to talk about what hedging is and why should you hedge your stock or hedge your portfolio. Hedging is one of the ways to protect your stock or your position from wiping out your balance, right? So before we start talking about, if you haven't subscribed to my channel, consider subscribing it now and hit the like button right now and subscribe now, because I'll be making more videos like this and you'll be seeing more of this. Yeah. So before I start talking about what hedging is, how do you hedge a stock? Let me give you a simple other example that is similar to hedging. You might have heard of this example even before, but I'll give it again because I hope this should make you very clear about what hedging is, and you should not search for hedging in any other video. So let's say you bought a car, a nice car, an expensive car. Okay, you bought a car for which you have paid 15 lakh. A pretty decent car, which is a little on the higher end. But let's say you meet with an accident in the first 1 month, right? You meet with an accident, which shouldn't happen, but just giving you an example. The total cost of damage and the cost of repair might come to maybe, let's say, 3 lakh, depending on the damage, how bad the damage is. But what if you had an insurance, right? Insurance might have costed you 30,000 per year, depending on what kind of insurance it is, or maybe 50k, right? If it is a more expensive insurance or a better coverage plan. So with this, even if you meet with an accident which would cost 3 lakh in repair, with 50k in insurance every year, you can bring down this cost to zero, or maybe some negligible amount, maybe 20k, because of some or the other reason, right? Or in ideal case, it should be zero because you have bought the insurance already. So what did you do to make sure you secure the car from further damage or further loss of money? You bought an insurance. This is similar to hedging in the stock market. So let me explain what hedging is in stocks. So before that, let's clear off all this. Yeah. So to talk about hedging in the stock market, let's say you bought, or maybe let's say you bought Tata Motors, right? Let's say you bought Tata Motors stock. I'll call it as TM, Tata Motors. Let's say you bought it maybe when the stock price was decent, right? Maybe let's say that stock price of Tata Motors was, let's say 500. Let's say it was going like this. You bought it today at some price, right? Let's call this at, you bought it at let's say 500 rupees. Thinking you made an investment here, thinking the price would go higher, a lot higher, and which can actually happen, right? You bought it for that reason, that the price would go higher. You expect the price to go higher, and maybe you might book a profit here by making money. Let's say 500 becomes 600 and you book a profit maybe a month down the line. But not always the stock moves in the direction you want it to move. But in fact, most of the times it doesn't. Mainly because the psychology behind stock market or the psychology behind how you would be understanding the stock market would not be right most of the times. That's why we are making videos here. But yeah, you need to subscribe to this channel and like this video. Okay, moving forward, let's say the stock does not go in your direction. What happens? What instead might happen is the stock went down. It started going down. Maybe in the next 2 days you observe the stock going down and you are in negative. You're making losses already. So this might wipe out your capital as well if it goes very low, right? If it goes to zero, if 500 becomes zero, of course a company like Tata Motors won't happen like that, and we wish that should not happen for the Indian economy. But yeah, just considering if it goes very low, let's say it goes minus 50%, right? If it becomes, let's say it becomes 100 rupees from 500, which is seriously bad, right? You might lose a lot of your money. You might lose like 80% of the cash that you have. So what's the best thing that you can do is you can hedge, Hedge. Just remember this word. Just keep saying this word, hedge. You should hedge this position now. So a very simple way to hedge this position is, the moment you observe the stock going down, maybe at this point, right, you observe that, you should start shorting it or short selling. If you don't know what short selling is, watch my other video on what shorting is or short selling, where I've clearly explained what shorting is. So how do you short? Let's say you go to the futures of Tata Motors, and then at that point you start shorting it. Short sell the stock here at this point. So by doing this, you are locking your position. How is this locking? It's locking because what's really happening here is, when the stock goes down here, when it goes to negative here in this side, when it goes to negative, you're making loss. Let's say when it goes negative, let's say about just one share, and from 500, if it dips to, from 500, if it dips to 400, you're making a loss of negative 100 here, because you bought this and it's going down. And when you're shorting here, for ideal case, let's consider this to be 500, and when this dips to 400, but you're shorting it here, when 500 goes to 400, you make a profit of plus 100. This is not exactly plus 100, and because this is futures, there might be a lot of other charges involved which might be very different, right? So you should be hedging your portfolio here. So how does this actually happen, right? And this profit here would be kind of equated with this loss, right? If this goes to, let's say if Tata Motor goes to 100 rupees instead of 400, if it goes to 100, you'll make a loss of minus 400. When you make a loss of minus 400, here, when it comes to 100, you'd make a profit of 400. So again, this is equated. So as much as this goes down, here you'll make profit. So this here, so since the profit and loss both are equal, what you make it zero. You don't either make loss or you don't make profit, but what you're doing is you're protecting the position. Later, when the stock starts bouncing back, right? When you start seeing stock coming up back, maybe at some point where you want to resume back, then you would close off this position and then continue forward. You want to continue with your normal profit back. All you did was you protected this part of the loss. You avoided this loss. You avoided being scared here. You avoided going through a mental, mental psychological effect here. A lot of them even get depressed when this happens, right? What you did was simple. With the extra cash you had, you just hedged or you shorted. You always need not short in futures. You can even short the same stock in a different position, but when it is long term, you can't short it in intraday because it's just valid for one day. So you do it in futures. Maybe this might last maybe for a week, not really more, right? Because you believed in Tata Motors and you invested. When your investment was right, it might have been some fluctuation which might have gone down. So this is how you hedge, and make sure you keep hedging because you don't. And so please, again, I'm just asking you to subscribe to my channel and like this video if you really like this video and if you found this to be useful, so that I keep making more videos. Hit the bell icon and subscribe now so that you get my more videos. All right, see you. Thank you for watching this video.